Hi, I'm Keith McCullough, and welcome back to another Real Conversation. I'm excited to do this one with a new teammate of mine. So this is part of what we call internally the HAM, or Hedgeye Asset Management, one of our new portfolio managers on that front, which is he's making my job much easier because now he gets to be the boss on the portfolio that he's running. Now, you can go to hedgeyeassetmanagement.com and figure out who Sam is. I think some of you have met him through different Hedgeye TV communications in the past and otherwise, but he's had a long-standing career as a money manager, and it's good to welcome a teammate, Sam. So thanks for joining me for a conversation here.
Hey, thanks for having me on, Keith. Appreciate it.
Yeah, look, first of all, he's a lot better than me at this, so that's why he's doing this. And this is, and secondly, I guess I want to get into right into the woods, Sam. Again, you worked for people who don't know, and maybe go through that to the extent that you want. I mean, you worked for one of the richest guys in the business, one of the great innovators in the world, in our profession, in Ned Johnson, to me and the quads. So how do you think about running money in your prior life, because you're still thinking secular growth, that's your style, to your current one?
Yeah, the main thing is that I think I've known the Hedgeye process for at least 16 years. I think I met you when I first got your early look in 2008. So I've known about Hedgeye for a very long time. So over the course of that time, it's become an important part of my process, in addition to my process. So, what I'm doing now is not that different to what I was doing at the family office. I think what's different is just the product structure is a little bit different. That provides a lot more flexibility than I had when I was at the family office, particularly with regards to taxes and so on. But the underlying process is not that different. But I think what is helpful now is, I've always followed the quads and the roadmap for the quads, pretty closely over the 15, 16 years I was there. But I think what's become a newer part of the process, and I think you've been highlighting this a lot in the last couple of years, is just how the flows in the market and how big money, be it retail or algorithmic trading money, really affects market movements and it influences how you should size and how you should position yourself at any given time in the market. And I think that's a thing that a lot of PMs struggle with and have struggled with for the last few years, along with, I think the quads are great because I think, again, one of the things that if you go back a long way, portfolio managers have struggled with whenever the regime changes in the market, we've all been positioned for the prior regime. Once it changes, everybody's looking around going, what happened? When they start underperforming. The quads are great because it gives you a roadmap for like what, at least based on the information we have now, what we expect the macro environment to be over the next 2-3 quarters. And when you add the analysis of the flow and how the sort of algorithmic systematic money is affecting markets, those two things have been very important components to how I manage money now, and particularly in this new environment.
Yeah, that we'll get into market structure and how it impacts what, Sam has to make a decision on the Mag 7. I call him the Moab 7. He's more polite. He'll call him the Mag 7. But again, it is what it is. I mean, we'll go through that market structure. But first, we'll go through the quads. I mean, that's really, Sam and I wouldn't get along. This conversation wouldn't have even started if he didn't use, from a North Star perspective, we call that your macro North Star. A lot of stock pickers don't have one, right, Sam? Can you just, you don't need to say why, you use the quads, but what do you do with them, okay? So we currently have a 3-2-1 quad count. When I say that to most human beings on Wall Street, unless they're a Hedgeye subscriber, they're like, are you counting down the minutes, before the bell goes? What are you doing here?
Yes, the importance of that is, it really should impact your portfolio construction. If you have that roadmap of 3-2-1 ahead of you, given what we know about historically what sectors and what types of stocks do well in those three environments, that should influence how you build your portfolio. So you're probably not going to build a portfolio full of consumer staple stocks and utilities that are more defensive and are not going to do well in that kind of environment. I'm trying to remember the last time we kind of had this quad roadmap. You probably know it like the back of your hand, but I can't remember a time recently where we've had this progression of going from 2 to 1. That's a very bullish environment. If you're an equity investor, you live for those environments because you got the equity market as a tailwind behind you, and then you have to really do your job, which is what you get paid for. Is did you pick the right stocks in the right sectors to outperform a market environment that's going to most likely be up in a quad 2, quad 1 environment, with the broadening of the types of stocks and sectors that do well in those two quads. So that means when you know that ahead of time, you should be thinking about, oh, how do I construct a portfolio to prepare for that? And that's like the most important way I use the quads, and how I've always used the quads is like, how do I tilt the portfolio in terms of construction based off of what I think is coming up. Conversely, the other extreme is if we know a quad 4 is coming up, you kind of know what to expect with that. And while in that kind of environment in the past, I had some limitations in what I could do in terms of turnover in the portfolio, I think in a more dynamic product or strategy where you can make those changes a little bit more aggressively, you can prepare again for, a quad 4 environment that is obviously clearly not good for equity markets. I mean, very simplistically, the way I think about it is of the 4 quads, this is very simplistic, of the 4 quads, quads 1, 2, and 3, you kind of have to think about the markets from a relative perspective, which is basically, how do I beat the market? Because the market most likely is going to be going up. Quad 4, the markets are going to probably go down. At best, maybe be flat, but most likely you're going to be prepared for a down market. So in that quad, you kind of have to think about the portfolio in an absolute sense. Okay, how do I protect or preserve or minimize my downside risk versus a market that's likely to go down? So again, you're thinking about two different dimensional ways of thinking, in a relative sense and an absolute sense. And as you said, coming up, we have an environment that's going to be most likely positive for markets. So the key is, how do you position for that to beat the market?
Yeah, when we say 3, 2, 1, we mean quad 3, quad 2, quad 1. Just for those of you that are new, because this is a free broadcast, we're trying to educate. Again, those are the quads. So if you go to slide 5, you can see where we show the quad map, what the quad map looks like. Again, you're going from quad 3 in Q3 to quad 2 in Q4 to quad 1 in Q1, right? So that's the roadmap. And then what we do is we back test those quarterly returns, in Sam's case, against sector styles, factor exposures on the equity side. You can show that on slide 7. And so that's going to, as I like to say, bleed your eyes out, but you can believe the numbers. That's what's historically has happened. And then finally on slide 8, you can see what Sam said. So, if we just go to quad 1 and 2, because again, quad 3 is ending, right? We have quad 3 in Q3. It's September. So, the market's constantly front running by 1 to 3 months, depending quad. And when you look at what Sam just said, go to quad 1, worst equity sectors. Go to quad 2, worst equity sectors. The 2 sectors that he just mentioned are 2 of the worst 3 sectors to have your money in: utilities and consumer staples. Okay? So talk about that quickly. Just not being there, doesn't it make your job a lot easier? It's a hard job to beat the S&P 500, but doesn't that make it a little easier?
Yeah, it definitely does, because you can spend more of your time, your limited research time, on the sectors that are going to matter the most. And, even with the strategy that I run, it's a pretty concentrated portfolio of about 50 stocks. I mean, it's even within that framework, it's still pretty diversified. So, I've always thought that regardless of the market environment, you can always find good stocks in a lot of sectors. But again, you're playing the odds. You're trying to play the probabilities to help you do as well as you can in the market environment ahead of you. So if staples and utilities are big underperformers in those two quads, you probably should be spending most of your time on the other sectors where you will get a lot more alpha and beta, but alpha primarily because that's the sectors that get the most attention in those two quads.
Yep, and just taking that like next level on portfolio construction, you got to have your sectors, your quads right, your sector styles right, your factor exposures right. How about the sizing piece? Can you get into, because I learned quite a bit from you in general, but just quite a bit from you in terms of, that's never been my job to beat the S&P 500. Like I don't run a fund that is tasked with that. That's why I say you're doing it because you're better at that than me. But again, like help people understand what it means to have an overweight position. I think I'm allowed to say it. I'm just going to say it anyway. He has an overweight position. His biggest overweight, correct me if I'm wrong, is in Google relative to your benchmark. Can you tell people that's a very good day for you today? So when I say, hey, how you doing today? And he's probably smiling because it's not easy to have a day like that. But can you explain that?
Yeah. So again, when you think about the markets from a relative sense, you want to beat the benchmark. I mean, ultimately, you get paid. We all get paid to do that. I mean, particularly if you're a long-only institutional retail manager. I mean, you are getting paid to beat the benchmark. So when I think about that, particularly with the largest cap companies, which are the most influential companies in the index, it's not just the Mag 7 or the top 10. There's 10 to 15 stocks that are pretty dominant weightings in the index. So when I think about positioning with those 10 stocks or so, if I like those stocks fundamentally, then I'm going to be over it, which what I mean by that is I'm going to have a weighting in the portfolio that is larger than the index weighting. And conversely, if I am nervous or cautious about the stock, I either don't own it at all because I don't like it fundamentally, or if I own it, I'm underweight it. For example, right now, I'm underweight Meta, and I'm underweighted for fundamental reasons. But the reason why I'm not zero weighted in Meta is because the signal is still kind of trend-wise, it's still positive for Meta, and the recent fundamentals in terms of the earnings the last quarter were very, very strong. My fundamental view is a little bit longer term, as I think in this whole AI sort of race and positioning of that, I think Meta, is not as well positioned as a lot of consensus investors believe they are. So I worry about their positioning in the next 2-3 years, but I'm looking for more reasons to go zero weight Meta, but I haven't done that yet because the stock is still doing pretty well from a signal strength perspective. So I'm waiting for the signals to kind of give me that extra piece of market information to press that underweight and maybe get out of the stock. And so I think about, overweights and underweights based off of those two things. How do I feel about the company's fundamentally, the strength of the near-term performance of the company, and if it matches up with what the signal strength is telling me, and how the quad positioning in terms of sector allocation is telling me, then I'm going to be more overweight than usual. And going back to, we can talk about Google and Apple specifically, but that's kind of how I think about the position, which I think is really more important for those top benchmark weights, because ultimately sometimes I wonder whether people get sick of us talking about the Mag 7 and the top 10 companies. But, when you really think about it, those top 7 to 10 companies are 40% of the benchmark. So you really have to know those companies cold, and not just the fundamentals. Obviously that's like table stakes, but you got to understand what is the positioning in the market, what is the signal strength, are they improving the signal strength, are they weakening the signal strength, and those two things influence how you should position in your portfolio. Otherwise, you end up in the worst case scenario with a big overweight in a stock that's losing signal strength, and that's going to be a big determinant of how you perform relative to the benchmark.
Yeah, signal strength was again defined in the early look note this morning. We made that up. That is our proprietary signal. So something, for example, like Google is bullish trade, bullish trend, guys, shows slide 9. It's in a bullish formation. It's bullish across all 3 durations, including the long term, of course. But it's also signaling higher highs in the daily risk range. So you can see that, obviously, because we publish Google in our risk range product and in our momentum tracker product. Of course, Sam's very well aware of all these signals. So again, something only gets signal strength if it's going up. Something loses signal strength if it's going down. Okay, so if you have longs that are going down and you have underweights that are going up, you will underperform if you're underperforming on 40% of your benchmark. So that's the real simple math on it, and why he's so focused on. He's using very specific mathematical language, even though it's Hedgeye language. But maybe, Sam, just to dial this in a little, guys, if you can show today, Tier 1 Alpha does a really good job, just showing a visual on the impact, the impact table, as we like to call it. I think it's definitely, from this morning, like you just mentioned Meta. So, for example, like Meta, if you go to the far right column, first of all, it was a drag on the S&P yesterday. We're showing the negative impact. But it's a 3% weight. Whereas something like NVIDIA is almost an 8% weight now. So again, these are gargantuan weights by all historical measures, and that's you can also have no weight, right? Like, correct me if I'm wrong, but you don't have a position in Tesla.
That's correct. Yeah, I don't have Tesla.
Right. Whereas most growth managers, or what they call secular growth managers that run an active ETF that is related to that strategy, own Tesla, do they not?
That's correct. Yeah. Jay Van Sciver, who's the industrial analyst at Hedgeye that covers this name, he knows this name inside out. But fundamentally, if you were to take the name and the CEO out of the equation, and you analyze the fundamentals of that business, this stock should be at least 50% lower. But there is a cult-like following to this name. So again, you have to just understand that, what you'd like to happen with the stock is not necessarily what's going to happen. So we don't own Tesla, but because of the fundamentals, and the signal strength will dictate kind of what happens in the future. But the work that Jay's done, and that I've read his work and other research that I've done myself. Tesla's one where it's from a fundamental perspective, it's difficult to when you see a stock that should be half the value that it is, it's like tough to make a case to be on the buy side of that. But for the other Mag 7, that while the signal strength and the trade messages may sort of change in any given period of time, I can make a better fundamental case for some of those names, which is why they're in the strategy that I manage.
Well, I think you could. We've talked about this. I think you could, if you're being, I guess, inconsistent with the process would be one way to put it. I think if you just slapped a huge price target on anything you own, like Tesla, you could probably raise some AUM in an ETF because it gets the attention of a lot of people who have no idea why it should be worth or could be worth half of what it's currently trading at. Like that is a thing, right? Like the ETF business in particular is loaded with mediocrity and marketing, right? So there is a thing going on there. How do you deal with that? How are you trying to deal with that? First of all, it's an ongoing exercise, but you enter this game of active ETFs, and you've run active growth portfolios, but you have this whole competitive set where your potential subscribers or clients that are invested in the strategy are used to paying attention to very different messaging on these names.
Yeah, it's hard because you mentioned the key word there, which is marketing. Now, marketing is such a big part of this particular part of the business, and some of our competitors in this space are active, prodigious marketers, and marketing in the sense of you touched on Tesla. I mean, forget Tesla. I mean, you could pick Coke, I mean, the most boring company in the world. Like, how could you put out a 10-year forecast on any company? And like, I think I'm pretty long term in my fundamental analysis of companies that I own. But 10 years, to have a 10-year forecast and a price target on a stock, and then to go market it like it's gospel, I think is let's just say it's interesting. But that is part of the business. And so what I've tried to do and what we've tried to do at Hedgeye Asset Management is the way we see the market, particularly on the active equity ETF side, is that you have a lot of the really, really big brand name companies that have active ETF versions of their mutual funds. And if you look at the constituents of those portfolios, they're essentially index plus. They're like 70, 100 companies in the portfolio, and they're basically benchmark plus for 70 basis points. And then on the other extreme, you have like these thematic ETFs that are like 35, 40, 50 stocks, but their portfolio construction is non-existent because in some cases they'll have, I don't know, 15% in one stock like Tesla. And so when you look at the construction of portfolios like that, you live and die by the performance of that stock. And if it works, that's great. But one stock drove your performance.
Right.
The others were just window dressing. So what we're trying to do, and the message we're trying to send to people is like, much like you did with Hedgeye, is like, I'm going to deliver to anybody that wants it for a nominal fee, institutional level hedge fund research that you only get at some of the top hedge funds. I'm going to deliver it to you for a nominal price. So what we're doing at HAM is the same thing. It's like for a nominal fee, you're going to get, and this is not just me, this is David Sullivan, now RPK, you're going to get institutional quality and level of portfolio management where we're going to build portfolios that can ride almost all markets with the exception of quad 4, which is a difficult quad to manage any portfolio in. But we're going to deliver the most efficient portfolios we can that maximizes alpha for a modest amount of risk. We're not a beta portfolio. The other ETFs that I mentioned, those are beta portfolios. When the market's chasing beta, guess what? They're going to do great. And when beta goes the other way, they're not going to do so great. So, I would hope over time, over the next 2 to 3 years plus, that the measurement that you should really measure me on, beyond stock selection, because I think that's every portfolio manager should live and die by stock selection, is risk-adjusted returns. So for every unit of risk I took, what return did I generate? Because that's the ultimate measure of risk management and alpha generation beyond just chasing beta.
Yeah, I mean, my 3 cents on this is, Jack Bogle, God rest his soul, gave us the ability to give the people low fees, right? Low fees in passive indexes. Then, and even though he fought it, it eventually became, instead of closed-end funds, it became ETFs. Hedgeye brings you this thing that Jack Bogle never did. That, as far as I can tell, there's not many active managers out there with ETFs may ever do, which is called risk management. It's an amazing thing to me but again, if the alternative is marketing, right, Sam? Look, if I have to wake up every day willing and needing to believe that Tesla could be worth $2,600, I just put it in my chat GPT and I say, what does a certain someone think that this stock is worth? Because the guy I'm talking to just said half the price. $2,600, all right? Now that's not a new price target, by the way. But again, So let's just get into the next part of this, because we just did a pretty decent bit on portfolio construction. We might come back to it. But this whole game of storytelling, narrative investing, like if you want to believe something, you can believe in anything. It doesn't mean it's true, okay? So again, if I look at the same ChatGPT and I say, well, why does she think it's worth $2,600? She's going to rattle off at least 3, maybe 5 or 6 different themes, long-term themes that I could believe in. Like you have themes, Sam, that I believe in. We don't know if they're going to play out or not, but we need to risk manage them through signal strength, through the quads. Last I checked, everyone who ran a growth strategy between February and April, the crash of 2025, we're old enough to remember that, got body bagged. All right, so they had no risk management process. And telling you to hold whatever it is that you're paying them to hold is not that. Okay, so how do you take the themes? Because you have themes. You have. I don't know why our themes would be any worse than anybody else who you think has good themes. But how do you take that theme-based component to your strategy and not make it a marketing gig?
Well, your point about risk management is again a very good one, because no matter how much I might like a stock or a theme, it's not going to dominate the portfolio that I run, because this is a diversified strategy, even though it's 50 stocks. So, I'm not going to I've done this for over 25 years since I've been managing money. I'm not going to live and die by one stock. So, like Google and some of Apple, are going to be are the biggest weightings in the portfolio. But within the construction of the portfolio, they will never be more than a 3% active weight over the benchmark. And that's kind of like a guardrail I've always had in my portfolio construction, is that whether it's a stock or whether it's a sector, I'm not going to be massively over or underweighted, because if I get it wrong, and this is part of this is one of the lessons you learn when you do this long enough, like you and I, is like the number one lesson you learn is and I learned this from Mr. Johnson too, which is amazing given what he achieved, is that, humility in everything you do, investing and trying to manage money in this market, because even in your best year, you have to be humble in the fact that, okay, I made some great calls. Maybe I got some lucky breaks too, but that doesn't mean that I am the greatest thing, since sliced bread, and I'm going to continue that for the next 2, 3, 4, 5 years, or whatever. And conversely, if you have a really bad year, and I've had a few, it doesn't mean that you suck. It's just that you have to go back and analyze, what did I do wrong? And how do I learn from this? And how do I get better? So one of the things I'm proud of in my track record is that if I had a bad year, and I had, I think, 5 or 6 over the 15, 16 years at my prior firm, the following year, I never underperformed the market. I always beat the market, because I spent the year that I was underperforming trying to iterate, what am I doing wrong? What mistakes am I making? And then looking forward is, okay, I'm going to start playing for the next year. I mean, you have a great hockey analogy. You go where the puck's going, make the next play. So I was always thinking about the next play. And so I think, that kind of is emblematic of risk management. When I think about risk managers, just being humble enough to know that I may have incredible conviction on my themes. I may have incredible conviction on my stocks, but I'm not going to bet the whole portfolio on one stock or one theme. That's how you build a diversified portfolio. You may have a lot of AI plays, which is obviously one of the big themes that I'm very optimistic about. I may have a lot of stocks that are levered to that play, but I also have other stocks in other sectors that have nothing to do with AI. And so if AI is having a bad day or a bad week, there's these other stocks that are doing well, doing better. So it kind of keeps everything kind of balanced and in check. So, like I said, you don't live and die by one thing or one stock.
But if you do, you got to market the shit out of that.
You got to market that out.
Yeah, you got to market let's go back to the impact table. Let's just use live examples. I mean, and what he just said, right? Tesla, if you have a market weight, you're right around 2%. If you have a 10 to 15% position in Tesla, you have to tell me that it's going to Buzz Lightyear and beyond. You better, right? I mean, it doesn't mean that it's going to be true. I'm not saying it's going to be false either. I'm just saying that is a very big outsized bet. And that's the point. Like Apple, he made the point. He said, the most I'm going to be, let's just reiterate what you just said and tell me if I heard it correctly. If you are overweight Apple, you have to have a larger than 6% position, right? But the max you would have is 9 because you don't go 300 basis points or 3% more than the benchmark weight. Is that correct?
That is correct.
See that? I think a lot of people probably didn't even know that, right? Like that's how it goes.
Yeah, again, it's a in a fundamental strategy where everything is very qualitative. You can still have rules-based guidelines and parameters that keep you within certain guardrails, so you don't do or inadvertently do something stupid in the portfolio. I mean, this market can make you believe like you really are, like a big deal when, the next day you get hammered because, you got the bet wrong. So again, it goes back to your point earlier, risk management. You ring fence yourself with some rules. You understand that, like in terms of construction, you're like, I made this analogy in the early look that I wrote while you were away, where it's like driving a car. You're taking a road trip. Like my fundamental view is, or the thematic view that I might have is like my destination, is like my North Star. But all along the way on that journey, I am adjusting as I'm driving the car, adjusting to the conditions of the road, so that I can get to my destination in one piece and not get blown up. And I think there's that goes back to this, understanding duration and duration mismatch, and learning how to be able to think about those two things at the same time. So that long-term horizon of where you want to get to is your long duration fundamental thematic view you might have. But in the short term, you got to navigate the road. You got to avoid those potholes.
Yep.
And the cliff, so you don't go over the cliff. So you're like navigating and steering that wheel to make sure you avoid those. And that is a short-term duration of understanding what is market positioning, what is happening with the flow, how you position for that in your portfolio, so you navigate that. And you tweak and adjust much like you do with a steering wheel. You're never like locked on the steering wheel, but you're always making adjustments. And that is kind of how I think about portfolio construction, is that you got to keep those two short-term, long-term horizons, in your mind at the same time.
Yeah, I mean, I think of the quads, the signal and the quads, and the combination of the two is headlights in the dark. I mean, you should have them. And they will tell you if a deer is oncoming. Now, a theme would say, I'd prefer that deer not to be coming, but that is not going to change your reality. So how do we deal with like themes? Let's go through a couple themes, more than a couple if you want. You got AI, you got deregulation. There are plenty of things that one could think is bullish, but they may not be bullish. They may not be as bullish as you think. They may be already priced in as too bullish. There's a lot of different ways to characterize what that theme could or would not be.
Yeah, if we take AI, for example, it's not like it's unknown. I mean, everybody kind of knows what's going on. So while I may have a positive 2-3 year view of it, you're always, like I said, you're always navigating the ebbs and flows of sentiment and positioning with these stocks, particularly the stocks that the collective basket that's part of the AI theme. So like, let's take NVIDIA, for example, clearly, a topical name. So, NVIDIA's had a great summary, and it kind of broke out. I mean, I think you called it on the signal strength um, uh, positioning like early in the summer. And it's been pretty much straight up since then. And it was one of my larger overweights in the strategy that I manage. But like, you had a catalyst and an event coming up with earnings. Is it last week or 2 weeks ago now? Where, I think expectations were pretty high that it was going to be a good quarter. And it turned out to be a decent quarter. It wasn't like a blockbuster quarter, but it was decent. It didn't change the actual fundamental story of why I own this stock. But I took the opportunity after like a really good summer to trim the position ahead of the earnings, because what if the earnings aren't that great and the stock goes down a lot? Do I want to be kind of going into that event with a pretty decent position? So again, this goes back to what we were talking about earlier. How do you risk manage positions in and out of catalysts? And so in the case of NVIDIA, I took the position down. I was still overweight, but not as overweight as I was going into the earnings. And conversely, with Google and Apple, going into that catalyst of that DOJ ruling, I mean, I really spoke at length with Paul Glencher, who I think is one of the best legal minds covering this stuff, and Andrew Friedman, who covers Google. And so right after that ruling wrapped up, I think can't remember, it was like early July and mid-July, I spoke to both of them about Google and Apple. And I felt pretty confident based off of that, and also my fundamental view of how AI is going to play out over the next few years. I think those two stocks, Google and Apple, are probably amongst the two most misunderstood of the Mag 7 as it relates to AI. And you can see that with positioning today after the ruling yesterday. And so kind of, positioning for catalysts that are coming up, you could do two different things. And with NVIDIA, I did one thing, which I trimmed the position going into earnings. And for Google and Apple, I was increasingly adding to those positions through the summer. And particularly when I got confirmation on signal strength, particularly in Apple, I really dialed up the weighting on that. Even though my Google position was bigger versus Apple, those two active bets became bigger over the course of the last month and a half or so.
That now that I know you didn't get from Ned Johnson. That is signal strength today. The reason why it's effective, i.e., accurate in generating alpha, is that the machine and market structure embedded in the machine perpetuates the signal. It is the signal. It's 40% of the flow, right? So when you think about it, like as opposed to just thinking about it fundamentally, you really have to have a next level of humility. I used this quote this morning. I mean, I'll use it again. It's from one of my favorite books, The Fighter's Mind. You heard it. It was in the early look. Many subscribers are going to hear it probably for the second or the third time, but I can't say it enough times. It's one of my favorite books for a reason. Behavioral books, like how do you run money? Like, and the quote is from Andrew Cooper, which is, unpredictably, the moment of grace breaks upon you, and the question is, i.e. the signal comes upon you, and the question is whether you are ready to receive it. Most people, first of all, they'd be like, huh? I mean, it's like, but if you use signal as a priority instead of your fundamental outlook, and you use it to augment your fundamental outlook, it absolutely helps you change the timing and sizing of positions, is what you're saying, correct?
Right, yeah. I mean, the added benefit of signal strength, or the way you calculate, is that most technical analysts, and I do use technical analysis a lot, but the only two things that they really track is obviously price and, in some cases, volume. The volatility part is what is missing with all that research, is what I think signal strength has that nobody else has. So that's an added component that just doing technical analysis alone, I'd be missing out on that factor, which is a very important factor. But I mean, combining those two things, for example, let's take the case of Google. If you look at a relative chart of Google. And when I say relative chart, I mean take the price of Google divided by the S&P 500, and you look at that chart, which is relative strength, basically. That's what technical analysis would describe as relative strength. Google has done nothing relative to the S&P 500 for over 3 years. Basically, what I mean by that is basically performed in line with the S&P 500. It's kind of traded in a range for like 3 years, almost since ChatGPT. That was like late 2022. Today, Google, relative to the S&P 500, has broken out of that 3-year relative base, based off the move today. So that is a big deal. I mean, Andrew talked a lot about the fundamental aspect of it, and I read his work. I spent a lot of time on some of the fundamentals, but that breakout on a relative basis on a 3-year basis, with probably volume and volatility, as I'm sure you'll talk about too, that's meaningful for a stock that on a forward multiple is still, after today's move, trading at a discount to the S&P 500. So again, I go back to my point about Apple and Google, for very different reasons, I think are the two, probably the most misunderstood are the Mag 7. And I think that's where the opportunity is, because everybody's offsides on those two names. So again, getting back to your flow positioning, guess who's chasing these two stocks today?
Yeah, again, for those of you that, and it's not like I don't use charts, right? I use predictive tracking algorithms, I use fractal equations, I use a lot in addition to the charts. But the idea that I don't look at, by definition, you have to look at a chart to see the price of something. But if you just put in, for those of you that use something like I would use for somebody's speaking, because I want to audit, Sam. I mean, we're business partners now, and I trust him, but I still look up what he's saying. I want to make sure that it's accurate, right? And if it's not, it won't be a huge conceptual surprise. I say things that are inaccurate because I can't remember everything, and then we correct them. But in stockcharts.com, you just put a 3-year chart of Google, SPY, okay? That's all you have to do. And to Sam's point, it's hitting a 3-year high today on that. And that is, again, up until really this last 3 months, that wasn't even manifesting. But the signal figured it out. In other words, the price, again, it's the rate of change of price, volume, and volatility. Somebody always knows something. And the collective wisdom of markets knew that Google and Apple were going to be the big two winners coming out of earnings season and in and out of this regulatory catalyst. So well done on listening to that. I mean, I'd say on the other side, just to, actually not even say on the other side. Let's look at something that has had, let's look at Netflix. Netflix has a pretty big weight. What's the weight of Netflix here in the S&P 500 right now? It's like 1%. When you were doing this for the Johnson family, a 1% weight was like a monster weight, right? But a 1% weight, you still respect that, right? If you have, hard-earned capital to get the hard-earned capital of the people in your strategy, a 1% position would be pretty big, wouldn't it?
Yeah, I mean, again, Netflix is one of those names that, of those big cap benchmark names, I like a lot fundamentally. I mean, I think a recent book that you read, Barry Dillon's autobiography, I mean, he's like one of the best minds in the media industry. And he was saying at least 5-6 years ago, I mean, his quote exactly is Netflix won. This whole thing about media, the streaming wars and content winners and losers. He was saying this 5-6 years ago, Netflix is over, Netflix has won. So, when, he's like, whenever he's on TV, I'll turn everything off and watch him because he is really, really a smart guy in that space. But again, Netflix I've owned since, 2015. But over that time, Netflix has had some major, major drawdowns. And so again, you position size accordingly to what is going on to the fundamentals of the company and the action in the price of the stock. But now going forward, fundamentally, Netflix has already achieved escape velocity. So they're no longer spending more than they're earning. They're earning cash flow wise more than they're spending, and they're still spending at an increasing rate every year. But their free cash flow margin is expanding because their rate of change of revenue growth is growing faster than their spend growth. Now, that wasn't the case 10 years ago when they
Yeah.
were spending much more than they were earning, and they were actually negative free cash flow for many years. So that that's an interesting name because when you look back 10 years ago, Netflix would be viewed as a disruptive company, like the beginning of an S curve, streaming, like a brand new concept of how people consume video. But it was like a brand new way of doing things, and it was accelerating growth in terms of membership over that time. Fast forward 10 years, now Netflix is a mature, large, established company that's now more of a compounder than a disruptor. I mean, they are compounding cash flow every single year,
Yeah.
and they can spend that cash flow on everything and anything. And I don't know if you have, I mean, I have a teen daughter who's big on like this K-pop Demon Hunters show that is going bananas on social media, and it's just insane. I mean, it's like the biggest movie in Netflix history.
Yeah, it's huge. I have one of those, a teenage daughter, but my 11-year-old daughter's into it too.
Yeah.
But let's just stay with Netflix. If people could see my screens, first of all, if you go back to 2015, on a split adjusted basis or whatever, you could have bought Netflix. Maybe you did for the Johnson family. Bought it like $50 a share. Is that right?
I can't remember what it was, but it was around 2014, 2015 that I bought it.
Yeah, that was the low for both the stock price, but also relative to the S&P 500, right?
Right.
Now, since then, of course, if you just look at the stock chart, it has one very unique thing that is unique to Hedgeye calling it. It's only gone down when Quad 4 has hit, right?
Correct.
But its relative performance in the absence of Quad 4 to the S&P 500 has been a beast since, in particular in the last 2 years. So it's been a big relative winner. The one thing you needed to risk manage was Quad 4, right? In 2022, Netflix got smoked, and it got smoked briefly this year when Quad 4 hit, right? So walk people through, unfortunately, you weren't running, and we didn't have the ETF business with you running your strategy during February to April, because they could have seen the difference between you and some monkey who's running what they think is a portfolio when it's not. It's a one-way bet with big concentration factors. Walk people through, because over these periods, you're a Hedgeye subscriber. So would you touch Netflix, or would you just say, okay, no. Quad 4 is coming. I'm just going to let this hit me square in the face.
Yeah, I mean, I think because of the tax sensitivity of the client that
That's different.
I was dealing with, it was a very complex management sort of question I had to deal with, because given that I knew that a Quad 4 was coming, how do I deal with that? And so there were ways I could take profits, or I could trim some stocks or raise cash going into that. But I knew, because of the fact that I couldn't make big changes to the portfolio with stocks that had gains over like 5 years, 10 years, even 15 years, in the case of Apple, those would be big tax consequences for a client like that. Right. So what I tried to do is, where I could, I would try to take defensive action, raise cash, reduce high beta positions where I could. But then I would turn my attention to, if it was a 1 month Quad 4, I would turn my attention to the exit of that Quad 4, knowing that I would have to ride through that Quad 4 because of the limitations I had. I would be looking ahead to say, okay, I'm going to pay attention to when Hedgeye Macro and Keith thinks we're coming out of that. And I would start positioning for that, so that I had a portfolio coming out of Quad 4 that was completely geared for the next few months and quarters. Which is why, as I said, when I had a bad year, I tended to do better coming out of it, because I was already planning for the next move. With this strategy now, where there's the opportunity to be a lot more dynamic, I think about the risk management process going into, let's say, a hypothetical quad four in four different levels or four different decision trees, as it were. So the first thing would be reduce weightings in high beta stocks, because those are the ones that get pummeled in quad four. Raise cash. Just park the money and just wait for an opportunity to go back in. Now with the proliferation of ETFs, you have ETFs that are anti-beta, anti-momentum, that can act as a sort of hedge within your portfolio. If you have a decent allocation, it can offset maybe positions that you had that you like long term, you don't want to necessarily, sell or reduce too dramatically. They can be offsetting factors. And then lastly, within the product and strategy that we have the option to overlay tactically options to kind of, again, hedge against, a deep quad four scenario where you can have tactical positionings to kind of offset some of the downside or minimize the downside. So ideally in a long-only portfolio, you want to come out of a down market at a higher level than the index, because you're always going to compound off that higher base. So if you can minimize that downside as much as possible, and you can come out of that compounding at a higher level than the index. And that's the goal, try to manage through those kind of environments.
Mm-hmm. And I guess the other thing you could do on offense is change the mix into new names, right? So again, one of the big things that happens during a 3-2-1 quad count is that you get a broadening of the rally, both in terms of factors. So small and mid cap starts to pick up a bid, and you start to get more sectors at work, primarily more cyclical sectors. So like industrials, financials, consumer discretionary, away from, like the XLY, two stocks is 40% of it. It's, that's not a portfolio. That's a bet. Yeah. Right. Can you talk, we're running out of some time here, but can you talk about like how, because I'm looking at names that you've added, I obviously know which ones. By the way, everyone can see what the holdings of any ETF are every day. How you think about adding positions that you haven't had in the portfolio, and how the Hedgeye research team or process, aids and abets that.
Yeah, so like I like any client of Hedgeye, I get access to the research that the analyst of sector has produced. So I follow that pretty closely. That, along with signal strength, is an additional source of ideas to me. So I think of idea generation in multiple buckets. I have my own fundamental framework and a list of it, an inventory of stocks that I've covered and looked at for over 20 years. And so I know those well, some less well than others, because I own the ones that I own really well. And also, like, the way I think about the signal strength list and the best ideas coming out of the research team is, again, a source of potential new ideas. So, those come into the portfolio based off of as we were talking about earlier, what kind of portfolio construction do I want to achieve based off of the roadmap that I see ahead of me, both from a macro perspective, but also from a thematic perspective.
Yeah.
And then conversely, when things make their way out of the portfolio, it's simply because of two things. Either the fundamentals are either priced in or they're starting to deteriorate. And also the signal strength and the research is signaling some hesitation or caution, either in an absolute sense, because the signal strength is breaking down, or the analyst is raising some questions about the fundamentals of the company looking forward. So those two factors in concert with each other are reasons why I look at a holding and say, okay, I have to now prepare for a potential exit. Mm-hmm. And it could be in stages if it's a large position, or it could be all at once if it's a mid to small position. It depends. A lot depends on the fundamental signals and the signal strength signals, and the weightings of those. And that's kind of how I think about getting out of positions.
On getting out, just last question on this, and you and I do go on and on and on. You can imagine, he's got to talk to me. He doesn't have to, actually, he doesn't have to do anything other than generate alpha, right? The on getting out, okay, because this has always been, this is like, well, let's just call it what it is. It's flat out an annoyance to me, right? Like when I have a client tell me, hey, I love your process. I know quad four's coming. I love the process, and I know quad four's coming. Did you say it again? Yes. But I didn't do anything because my boss and our process, really prioritizes tax decisions. I mean, I mean, I just kind of, I just cringed out loud, right? Like, I mean, would it be reasonable for me to expect, because this is what I expect, would it be reasonable for me to expect Sam Rahman to be a better portfolio manager in terms of absolute alpha generation and consistency of alpha generation, not having that tax decision to make?
Well, I mean, past performance is no indication of future performance, as a disclaimer. But there is a level of freedom that I have now with this new structure that I didn't have in the past. So, that makes things a lot easier. So when things change quickly, we will know when the next quad four is coming up. But as I said to you, and I say to prospective clients I've spoken to over the last couple of months, there's a level of dynamism with the changes you can make in this kind of structure that wasn't available to me before. And so, I mean, whether that makes me better or not in terms of alpha, that's still to be determined. We'll see. But it'll give me the flexibility. It'll allow me to make changes a lot quicker.
Yeah.
Let's say that than I was able to do before.
Yeah, it's like when my son finally figured out there was a governor on the go-kart. Like, if I remove the governor, Jack, you can definitely go faster. You can make decisions faster in your case. But that doesn't mean that you cannot crash faster.
Right.
Or that you can't make, because there is a, the game is the game, right? There are constraints, and constraints can really help one get better at it because it's harder to play constrained than it is unconstrained. Unconstrained can also lead to a lot of bad decisions. So it's great just to hear you, talk through that and talk through, doing the job professionally for so long. I guess I just complained about it. Like what you watch on CNBC or read in the Motley Tool, about portfolio management and from some of these ETFs, it's a joke. That if it wasn't such a good joke, it wouldn't be the longest running comedy on cable. Here is the solution, right? So thanks, Sam, for helping me be part of the solution, because I'm not a whiner. I'm complaining because people are getting sucked into bad product, right? If it was good enough for people to understand why Bogle was right, lower fees are better, risk management's better. Having signal strength, modern tools, an entire research team that's independent and apolitical, it's just better. And everybody knows it. So thanks for helping me bring this to life, because I certainly couldn't do it without you.
Hey, I appreciate it, Keith. Thank you so much for having me on. Thanks again.
He's Sam Rahman. Now you know why I like that guy so much, all right? So again, and here's an open question. Like, are you your own Sam Rahman, right? How do you use the Hedgeye tools, and how do you use the Hedgeye process to express a diversified, go-anywhere portfolio? Whether that's a USA-only diversified and go-anywhere in the USA portfolio, or a global one. Doesn't matter to me. It should really matter to you, right? And that's really, the goal here is to bring asset management products to life using everything that we've built. It was a long time coming, and I'm certainly glad that we've done that. So thank you for supporting it, for those of you that have, and for those of you that are new to this, thanks for joining us.